Okay, let's get started. Thank you everyone for joining the webinar today. My name is Michael Hansen, Program Manager at the Action Innovation Network. Action is a collaborative network of technology business incubators and other entrepreneur support organizations located throughout the New England region. Our network supports startups developing technologies across a wide range of tech industry sectors, including life sciences, clean tech, robotics, ocean marine, and advanced materials. Our Plymouth Rock project provides a suite of resources for international startups that are interested in exploring this innovation ecosystem as a place to grow their company in the US. A few items to review before we start the presentation. All attendees will have their audio and video muted. The presentation will run approximately 45 minutes, followed by question and answer. If you have a question for the presenter, Ben, please click on chat and use the chat window to submit your question to the host, and we'll address those questions during the Q&A at the end. This webinar is being recorded and will be emailed to you afterwards and also posted on the Action website for future viewing. Today's webinar, How Investors Are Using Revenue-Based Financing as an Alternative Model for Funding Startups, is presented by Ben Littauer. Ben is an angel investor with expertise in internet and communications technologies, as well as healthcare IT and the Boston funding ecosystem. He is currently an active member of Walnut Ventures Associates and a former member at Boston Harbor Angels and Launchpad Venture Group. He's made over 40 investments in a wide variety of startups and sits on the boards of several portfolio companies. He's a mentor for Mass Challenge and the Capital Network and is on the advisory board at the Capital Network. Mr. Littauer is a judge for Mass Challenge, CRDF Global, and various academic competitions. You can view his full bio on the webinar event page. Thank you for presenting today, Ben. We look forward to your presentation.
Thanks, Michael. So as way of introduction on this screen, you'll see that I had to cross out March 101st, which is what it sometimes feels like. I will be mentioning on a later slide what my thoughts are around the pandemic and how it affects investments. So that's why I left that in there, even though it really is June 9th, hard though that is to believe. So Michael has given you some information about me. The thing I highlight most here is that I'm a small-time investor with a big mouth. My investments tend to be very small, so I need to convince a lot of people to work with me. And I've been interested in revenue-based financing for almost 2 years now, and I have yet to do a deal in that realm. So we'll talk about why that is as we proceed. Before I get into revenue-based financing, I'm going to review for those who aren't up on it. What do angels and VCs typically invest in today? And we make what are called equity-based investments. In other words, we buy shares of a company, and we buy them at a price per share. And then sometime later in the world, the company has grown enough and built enough value that when it finally does what we call exiting, which is either does a public offering of its stock or gets bought by another company at a certain price per share, we hope that our price per share has gone from, say, $1 a share to $10 a share, in which case we get back 10 times our money, or $1,000 a share, in which case we get back 100 times our money. In addition, the kind of shares we buy aren't the same kind of shares that the founders have. The founders have something called common stock. We get preferred stock typically in most angel and VC deals, where if things aren't going really well, or even sometimes if they are, we get our money out first, and then the common hoi polloi get their money out. And so this can actually stack up in very negative ways for founders and often for early investors where, you know, hey, the less money in gets to write the rules. Now, for seed stage companies, those companies that are really young, we often use different instruments that actually, when you think about it, are still equity investments. Some of these are called convertible debt or convertible notes. You may have heard of these, or these SAFE agreements that were initially launched on the West Coast by Y Combinator, which are simple agreement for future equity. Basically what they are agreements that we don't know what the right price is for this stock. Is it $1 a share? Is it $2 a share? Or is it 50 cents a share? Why don't we let the next investors figure it out? And we'll take a discount on that. And you can get as complicated as you want with these. But the basic idea is you should still think of these, even though they're structured as debt or a contract, in the case of convertible notes as debt, or in a safe as a contract, you should still think of them as an equity investment. And if you want in-depth detail, the Capital Network has been doing this for 25 years, or more than 25 years, I think, training entrepreneurs what the whole funding process is about, including all of the gory details of these things. But let's talk a bit about the angel investing portfolio. We typically do a portfolio play, which is a diversification play. And so we will bet on a large number of companies. I've invested in over 40 companies in 12 years. What we're betting on is that one company is going to return that 10x, i.e. we get a return of, it exits with a price that's 10 times what we paid. And that'll sort of make the portfolio work from a returns point of view. We'll get a couple of base hits which have less than 10 times return. And then there's some losers in the portfolio. Now, when you're a seed stage investor like I am, we get a lot of losers. And losers come in two categories. They just die, companies that run out of money and crash and burn, or they never exit, or they exit for fractional, for pennies on the dollar because they really weren't successful. But what does success mean in this context? Success is typically measured as growth. We want to see meteoric growth, and we're less concerned with profitability, and we're less concerned with any sort of returns in the short term. We need to see growth because that's what attracts buyers and investors later. And when you're a VC fund, you're spending a lot of money, and so the fund economics actually will drive the portfolio. So they may say, you know, this exit where some company decides to buy one of their portfolio companies for a small amount of, you know, twice the investment that they made, it just doesn't make a difference to them. If they invested $1 million in a seed stage company and someone offers them $2 million back and they have $1 billion fund, that just doesn't move the needle for them. So they won't be interested in that. For angels, however, if we see a 2x return in a year, hey, that'll let us play for a while and we get a good IRR, which is an internal rate of return. We doubled our money in a year, that's 100% IRR. That's a great deal for us. So we will behave a little differently from VCs, but on the whole, we're playing the same game. One way to think of it is VCs are hunting unicorns. These are the companies that are like Facebook or Uber that have billion-dollar valuations. And I use the word valuation with a little bit of quotes around it because I really prefer prices as a term. But they have these huge valuations and have, you know, done meteoric growth based on a lot of money going in, probably more than they need, but certainly an awful lot of money that goes in. And I was on a panel recently with the local VC here in Boston who said, you know, we're no longer looking for unicorns. We're looking for what he called decacorns. This is actually a term, it turns out. These are the companies that are $10 billion valuations, not $1 billion. And that makes it even harder for the companies that I'm about to describe to get money. In Boston, the angels are a little more modest in their aspirations. We are typically looking for companies that will exit not with an IPO, but typically with a merger and acquisition from a bigger company, and we're looking for 10x's at best. If we get a 3 to 5x in 3 to 5 years, that used to be the sort of litmus test. It doesn't happen, but we're hunting zebras. We're not hunting unicorns. But what if you're a horse? Before I go into that, I just want to take this. This is actually the fellow who introduced me to this round of revenue-based financing was a guy named Looney Levis, who runs a fund out in Seattle for social good as well as returns. And he's been a strong promulgator of revenue-based financing across the board. If you look at a typical angel or VC portfolio, we get one company that gets the 10x return that I've talked about, a few that get 5x maybe, some singles, and a bunch of zeros. But if you look at it, the 3 and 4, those 7 out of 10 companies, they're more or less failures. And it's very likely that in those results, in the zeros, nobody got any money. In the singles, it's typical that the original investors, or the latest investors more likely, get their money out and nobody else makes a dime. So those are failures from the company's point of view. The founders aren't getting money. The early investors aren't getting money. That's a very sad statement. 7 out of 10 are failures in the angel investment return, while the portfolio is being a success. It gets 2.3x average return. Wow, that's great. So what about these horses? What describes them? If you go into an investor meeting, you will often be asked, are you a lifestyle company? And if you say, what's that? It means a company that's just going to grow slowly and be profitable and not going to go to the moon. Well, if you say that, you've just kissed your money goodbye. Your investment is not going to happen at that point. Lifestyle company is the kiss of death in the angel VC world. But there are a lot of businesses that are lifestyle companies that are, really great companies, but we're not going to give you money. So services companies, if you're a consulting house, we say, well, all of the assets have legs and so could walk away. So we're not going to fund you. Any slow growth company where, it's not going to be a rocket ship, but hey, they're going to make money. And if they get more salespeople, they can win. It's a great company, not going to fund it. Niche markets where it just can't turn into a $100 million company, a $1 billion company, or a $10 billion company. It's just not worth getting our checkbooks out, we say. So that's one downside of being a horse in the unicorn market. Now, people will still position their companies. Entrepreneurs will do this all the time, say, oh, I'm going to be a unicorn. I could be a unicorn if you give me enough money. But businesses that take that road become addicted to growth. And so we will actually end up killing those companies. Those 7 out of 10 companies might have had success had they gone the slow profitable route rather than the high growth route, because they're constantly needing the next capital infusion because they're not profitable. And so if you suddenly have a $10 million loss on your balance sheet, on your P&L, you actually have to get more money to cover that because it's real loss. And so you need to make sure that the people who are funding you are willing to give you more money and more money and more money. And you're constantly on this treadmill to get the next round. And you hear this all the time. And if the next round doesn't happen, I get this email from my portfolio companies, and I know that there's a problem when they say, we're going to focus on profitability for the next 2 quarters. That means they didn't land the next round. And it's usually a signal that they're circling the drain. And that's very sad for me. I don't get my money out, and they could have been a good company. So what is a typical company that might be a horse? And there are many forms of these. I've picked one. Let's say you're a small enterprise software company. You're not a game changer, but you solve a real problem. Let's say you're automating a process that's currently manual, but it's a limited market. And you can show a real return on investment. If they buy your product, they'll save money within a year. That's a wonderful thing for a company. You might be in a niche market. Say you only work with, hospitals, small hospitals. So it's a niche market. You have some initial sales. A few hospitals have bought your product and say, it really works. And so they're paying you, they're giving you money, you're giving them software, and everything is looking good. But you'd like to grow and move out of your local region, and you need some more salespeople, and your customers have asked for a few extra features. And once you have more customers, you're going to need more support people. That's all expenses that you have to pay up front. And so you can't just do it out of cash flow easily. So that's where you start saying, I could use a little extra capital to kickstart this into the next realm. But you're too small and you don't have collateral to get a bank loan. What are you going to do? And that's where revenue-based financing is geared to help. So what we do, if we do a revenue-based deal, is we give you some money. Let's say you take $100,000. And then we say, don't start paying us back for a year. And during that year, you have $100,000 to play with, to hire a couple of salespeople, to hire a support person, and to finish off a couple more features. And you grow because you actually, at the end of the year, you have more customers who are happier with your product. So at that point, we start asking for you to pay us back. And we'll ask you on the basis of cash coming in the door. So a company buys a one-year subscription and you get $100,000 for that contract. Great, we'll take a percentage of that. And when they pay their bill, we'll take a percentage. We do that on a revenue basis, really a cash basis, because it avoids a lot of accounting trickery. If you do it on a profit basis, profits are easy to hide. You can say, well, I'm investing in R&D, so I was unprofitable. I hired a couple more people, so I was unprofitable. So you don't get any money, investor. We don't like that. So that's why we're using top line in the revenue-based financing models that I'm aware of. There are some exceptions, though. And one of the keys of this is you aren't wedded to us forever. We say, we aren't going to kill you, and we're going to be more selective about companies that actually have a chance of surviving than these crazy startups that have unicorn ideas. We're going to hang around until we've gotten 3 times our money back, say. And then we walk away and you walk away. And we may keep a small piece of equity just in case it turns out we bet on a unicorn and didn't know it. But at the end of the day, you own your company, or most of it. And that's a huge advantage. So you don't give up equity, typically. And when you think about equity, and I'm going to get into a couple of charts in a moment that illustrate this, equity is very expensive money. Think of it. You take in $1 and later you pay out $10 for it, okay? That's a huge, and say it happens in 10 years, that's a huge rate of interest for that dollar that you borrowed, you got, okay? And so it has a huge interest rate. Another advantage of revenue-based financing, and this is more compared to bank debt, is you get a grace period. You can use that growth, that money in advance of growth to help you develop and grow. And then we start charging you. The bank starts charging you the minute they give you the money. The payments aren't flat. So if you have a seasonal business, say you're doing something that typically slows down in the summer because you're working with the academic year or something like that. If you had bank debt, you have to pay it every month, even if you have a short month, and that can be very painful. And in revenue-based financing, if you have a lot of customer activity this month, people start really liking your product, well, you're going to pay us a little more. But think of paying back your investors sort of like paying back any service that you're doing. I use Amazon Web Services here as an example. That's the one that Looney uses in his webinars as well, so I stole it very happily. If you have a big month, your web services bill goes up. Great, but you have the money to cover it. Most debt, including venture debt, will often require a personal guarantee on the money. That means that if I'm an entrepreneur and I say, hey, lend me some dough, and they do, they may have a lien on my house. My wife's not going to like that. So that's a difference. Typically in revenue-based financing and in equity financing, we don't take any sort of collateral or guarantee. When you take revenue-based financing, the assumption is that you're a slow growth company, and this is sort of the last money in unless something goes really, really incredibly well, and your growth outstrips your ability to fund it with cash flow, in which case you might convert to an equity deal. Most revenue-based financing leaves that as an option. But you aren't on that funding treadmill because you are profitable. And that's the key to success in revenue-based financing. I've talked a little bit about the seasonality, but what we often see in VC and angel deals is things go slowly for a couple of quarters. The first thing that the investors do is say, well, maybe it's a management problem. And so they axe the CEO. I'm fairly unhappy with that model. I've seen it happen too often without a good replacement CEO in the wings. This happens less often because you own the company still, and so they may not have even any control options. So here are some charts. This is straight from Mooney's pitch deck for revenue-based financing. This is the typical angel VC model. We throw in some money on the left there, that's the investor capital. You grow, and we don't care about the profitability because we're going to keep putting money in, and you keep growing and growing. And then at some point, there's an acquisition of your company or a public offering, and we get that 10x return. That's how it works in theory, and we don't mind if 3/4 of the companies end up in the bucket down at the bottom. We only care that one of them does an incredible job. With debt, it doesn't work for these slower growth companies, and I will adjust this slide on the next one to show really if you're a debt company, your growth rate is supposed to look like this. You're going to bring a little money in to get your pizza oven, and then you're going to start selling pizzas, and you're going to pay off your debt, and you're first going to pay it off out of capital and then eventually out of profits, and it's okay. For risk investors like angels and VCs, this doesn't work for us. We get too little back, and in the beginning, it's expensive for the company, and then when you start adding seasonality in, if you could even get this money in the first place, because most banks won't even look at you. So on the revenue based, again, I'd adjust the rate of growth down a little and make it more linear growth than exponential growth that's illustrated here. We get our money back as a percentage of your success. So our interests are highly aligned. And there's a fixed total return. When you get to 3x, we're out of your hair. Isn't that nice? Now, all is not rosy here. Certain companies just don't qualify for us. You can't be a Facebook. They needed to collect millions or tens of millions or hundreds of millions of users before they could make a dime. They're not going to be profitable. They weren't profitable when they started or got lots of money. That just doesn't work. If you are a biotech company that needs to go through a regulatory process and a clinical trials process, you're not going to make revenues in any sensible amount of time for this model. So forget about those kinds of companies. They're not going to happen here. Another disadvantage is you have to manage to your income. You can't grow as fast as you might like to grow. And this is something that many entrepreneurs don't know how to do. They've been trained to the growth model. Forget about the bottom line, just care about the top line. And so it's a bit of an education problem to say to the entrepreneur, no, actually try to build a profitable business. And how do you do that? Well, we'll let you know, maybe. You have to have good margins, as we say. And that means that your EBITDA, which is some accounting term, but basically it means your profitability has to be sufficient that if we take 3, 4, 5, 8% off the top, you can still run your business. If you are a slim margin business, say groceries, where they operate on a small percentage, in huge volume, it's not going to work. We can't take enough off the top. Maybe you could take 0.5% off the top and still survive. But with slim margins, things don't work. This is moderately expensive money. We have a high effective interest rate. For those time, when you're paying us back 3x in 4 years, that's a fairly high interest rate. If you could get bank debt and afford to pay it in the way that they ask for it, you might be better off. Their interest rate is going to be lower than ours. From the investor's point of view, there are a huge number of tax advantages at the federal and at some state levels that make it great when we win. Sometimes we don't have to even pay capital gains. When we lose, we can sometimes deduct the loss against ordinary income rather than capital gains income, which is a huge win from a tax point of view. I personally don't invest on the basis of my tax position. I don't think that's the right way to go. If things are really successful, I don't mind paying a little extra in taxes. But many investors are highly conscious of this, and it's an important thing. Revenue-based financing doesn't have those advantages, and if it's structured as debt, it's pretty clear that it's the payments are taxed as ordinary income. That's a shame. At least in equity, the worst you're going to get is capital gains, which is cheaper from a tax point of view. You still need to build that reproducible revenue stream. We're not going to invest on a revenue-based financing instrument if you don't have revenues and good margins and show that you can do it again and again. We prefer recurring revenue. In other words, that you have long annual contracts. Software as a service is the typical sweet spot for this. And finally, the unfamiliar structure. People don't know what this is yet. And there are so many different flavors of it, which I'll get into in a moment, that it's very confusing for the investor. How does this work? And why would I give up the chance to get a 10x return and limit my upside to 3x? That sounds really stupid to me. So it's a complication. People don't understand it. And if you do need more money, people will say, well, what about that weird instrument you assigned 2 years ago? What does that mean to us? So it may complicate your life if things don't go exactly as planned. So as I said, there are a lot of structures out there for this. There's a debt structure where the investors lend your company money on a legal basis. It's a debt instrument and it gets paid back over time. And there are investment funds that do this as a matter of course. So one locally here that's very active on the east, in the Northeast here, is called RevUp, and they invest money and then they help you along with your sales process so that it grows, so that the company grows, and you pay them back 3x their money. Isn't that great? Lighter Capital does a similar thing. They're a national fund. You can also invest as an equity, and what happens is you buy stock in the company just as if you were an equity investor or an angel or VC, but there's a clause in the deal that says the company is obligated to buy back the stock at 2 or 3x what they paid for it until it's gone. And so Looney's fund called Fledge does it on that basis, I believe. And finally, you can do something which is sort of like a SAFE. It's a contractual obligation that says we can buy equity should equity come into the company. And so we can ride along. And so in that way, it's like a SAFE or a convertible note, although it's not debt, so it's not a convertible note. And we agree to buy that equity later. But that right is bought back and whittled down over time. And so you buy back some percentage of the equity each month, and eventually it whittles down to zero. And that's the hope, that you'll have no obligation to sell equity at the end. The prime place doing that is a fund called Indy.vc, and they very kindly have published their whole methodology on the web, so you can see it and understand it. And I want to thank Jay Batson, one of my colleagues at Walnut, for introducing me to them. It's a model that I think is very solid. It may have better tax consequences. They're also in revision 3, and for those of us who have software backgrounds, we always know that's the first version that actually works. So there are a lot of questions about revenue-based financing, and I'm sure you'll ask some in a few moments. But the first question is, if this is so good, you've been hanging around 2 years, why haven't you done a deal yet? And there are a lot of reasons. One is I'm a small investor. I have to get a bunch of people to go along with me. It seems to be getting easier, but I haven't done a deal yet. Another reason that I haven't done one is the companies still think that they're going to be unicorns. I've worked with one company in particular for a couple of years. They were convinced they're going to be a unicorn. They wouldn't even think about taking revenue-based financing, even though they had some revenues. Another reason, and I'll get into this more, is COVID. There were a couple of companies that I've been working with that had really good revenues, but, you know, pandemic sort of said, this isn't a great time to raise money, maybe, and let me just focus on keeping my revenues rather than growing. If it's so good, why isn't everyone doing it? Again, it's something of a blinders question. It's something of most investors like lottery tickets rather than solid plays. Hey, if I can get in on Uber, I was talking to an investor a couple of years ago who was an early Uber investor. If I did my typical investment of, say $10,000 into that deal when he had done it, how much would it have been worth when I talked to him? Oh, only $50 million. It's insane. That's a wonderful lottery ticket. And people are addicted to gambling. But more and more people are doing it. As I keep promulgating this, I see more and more people who say, yeah, I've got interest. Yeah, I'm doing it. So I think that there is a groundswell towards it. So if I have to have this much recurring revenue to even get in the door with you, how do I get there? If I'm a software company, how do I build the software for the prototype so that I can sell it and show you that I've got recurring revenues? That's a serious problem, and one that we need to address if this is going to be successful. In the meantime, there are companies who get there on friends and family money, or through a stroke of luck, or have been able to build it organically through some other means that are still appropriate for revenue-based funding. So that's a problem that I'm hoping to defer until later. What do you mean, manage to cash flow? People aren't taught that. It's a lost art to actually run a small profitable company, I'm afraid. We've all been taught, go for the VCs, get that big money and just take off. So we have an education problem. There's an accounting headache here. Unlike an equity investment where all the accounting happens at the end. You get an exit, Google buys you, and all of a sudden there's a bunch of spreadsheets that get passed around, and it says, hey, you made 5 times your money on this deal. Great. One-time operation. It's a big one, but who cares? You're getting a lot of money out of it. in revenue-based financing on a monthly or quarterly basis, typically, you're going to have to open your books to an accountant, say, here's how much cash we took in the door, and they're going to have to pay out to the investors. That's the way the model works. So it's somewhat more work. That's going to be an issue. Then there's the whole question is, what if I say, no, I'm not going to pay you anymore? What is the recourse? What are the deals that have to be made in order to make that less likely and more understandable? And the biggest problem is most investors haven't heard of it and haven't done it, so there's no experience in the area. So we're really at the leading edge of this movement, I think. So in working with my colleagues, we're talking about doing this, but we recognize that for this to be successful in the long term, there has to be a whole ecosystem around it. There has to be a lot of support that happens. So we need to educate the entrepreneurs. You know, you don't have to be a unicorn. We need to educate the investors. You can invest in horses. We need to provide some seed funding. Maybe we don't need to do that to launch the product, but over time, we need an instrument that says the next funding that comes in is likely to be revenue-based funding. So if you put money in now, we'll give you a reward for taking on more risk, but expect it not to turn into equity, expect it to turn into one of these instruments. We need to manage the deal flow. We need to source good companies that already have revenues or look on a good track to get recurring revenues. We need to help the investors look into those revenues, have an accountant make sure that those numbers are real and things like that. So it's possible that there's a room for a platform like AngelList for angels and VCs, but for revenue-based financing. We need to actually put the money in, and that means we need to get a bunch of investors and show that it at least is attractive, and later we can show that it's successful. We need to manage the accounting. Again, a platform would be very helpful here, but in the short term, it's okay to just use an accountant. If we only have half a dozen companies, it's not such a big burden. And we need to manage the disbursements so that the investors at the end of the day say, yeah, they actually paid me and I made money on this deal. Isn't that wonderful? So there's a lot of stuff that needs to be done. My colleagues and I are working in the lean startup methodology to try to come up with a plan that doesn't make us add all of these features at once, but we can do a few things well enough that it'll demonstrate success and then move on. Just as the lean startup suggests that you build an MVP for your product before you go and build all the bells and whistles, you make sure you have something that the customers are willing to pay for. For us, that investors are willing to participate in and that companies are willing to take that kind of money. So I'm going to shift for a moment to the pandemic because I'm sure it's on most of your minds. What does it mean for investing? In particular, what does it mean for revenue-based funding? Most of the investors in my network are still talking about investing. Now, I'm an angel investor. I don't, and my colleagues typically are not betting our retirement funds on angel deals. We've segregated some money away that we can afford to lose. And so that money is still there. It may be smaller because our bank accounts have shrunk. It may be bigger because we foolishly left it in the stock market. But that money is still there, and we're still talking about investing. Whether we're doing more than talking remains to be seen. You know, I think that there are deals that will still be funded. VCs, on the other hand, are still required to spend. Their funds have lifetimes attached to them. And if they don't spend the money, they're delinquent in their jobs. That said, investors, both angels and VCs, have portfolio companies, and they're also in the valley of doom right now with revenues down and development harder, all sorts of things not working the way they used to. And so we may need to keep a little what we call dry powder for those companies so that when they have a little bit of a cash flow problem, we can help them out. On the acquiring side, companies, big companies, might find themselves a little cash strapped if their income is down. You know, don't try to sell to TripAdvisor right now. They're not doing very well. So they're not going to buy a little travel-based company right now. We don't know what's going to happen with IPOs and acquisitions. There's some indication that IPOs are happening faster right now, but the question marks in the pandemic are a lot of the problem. We don't like operating in complete mystery. But many investors, VCs and angels alike, look back at their portfolios and said, you know, the companies I invested in right after the 2008 crash, they did really well, because the prices on those deals might have been lower because money was harder to come by. And, you know, they, as a consequence, grew up very well. They also were dealing with a cash poor environment, and so they had to solve real problems and may have taken off as a consequence. In this environment also, companies, smaller companies, bigger companies, are all much more concerned about efficiency. And that makes niche plays more attractive to them as customers, not as buyers necessarily, but as customers. And for the revenue-based financing, that could be a huge win. Suddenly, you know, I have to worry about my HR department spending too much on the hiring process. And if I can bring in some software that improves that by 25%, that's a big win. The other thing that is happening in this is that many investors are saying, why are we limiting our investment to local? It used to be that I would say, you know, Walnut invests only in New England companies because we want to be able to drive over to your place with a baseball bat and hit you upside the head because you're doing something wrong. In the age of Zoom, and I don't think that's going away after the pandemic, we may be much more flexible about where we invest. And I think that's a wonderful thing, because there are so many great companies, especially small profitable companies, that can be that can benefit from not having to be in Boston, because Boston is so expensive. That can benefit from being able to service customers locally in the middle of Iowa. You know, that's the sort of stuff that I think will really help. In addition, I think that the less restrictive environment will, I hope, enable companies that are started by people of color or women to really have a leg up, because often those companies look like small profitable companies, and are we as investors discount their chances of success. Whereas if they've shown success, it's a great thing. So I'm going to stop here. I'm going to acknowledge Looney, who I've already mentioned, and Jay, who are both working with me, and I'm thrilled to have their help. A lot of colleagues in the ecosystem have been very supportive, and my wife has really bought into this whole RBF. She never liked the angel investment model. What, you kill 70% of your companies? That's terrible. She believes in this, and so she might let me spend a little more. And I've listed some resources here for you, and I think that Michael and John will be sharing this deck with you along with the recording of this session. So I'm open to questions now.
Thank you, Ben, for that very informative presentation. Just as a reminder to everyone, if you do have a question for Ben, please click on the chat button and submit your question through the chat window. So we have several questions to get us started. The first one is, do you think this model will be applicable for a life science instrumentation company or CROs?
CRO, by the way, is a contract research organization, I believe. They are a services company. I do think so. If your life sciences instrumentation company has customers and is moving along, but needs, again, to grow more quickly, but doesn't have a 3-year FDA approval life cycle, there's a good chance that you have revenues, you want to grow, it might well be applicable. It depends on your margins, but if you can afford to give 3 to 5% to your investors after a year, it might be a very good bet.
Okay. To your point that taking revenue-based financing could complicate future rounds, could there be a use case where a subsequent investor buys out the revenue-based financed investor as part of a priced round? Or does the equity run in parallel with the revenue-based financing staying in place until it pays off on the initial terms?
That's absolutely possible. I think the devil is in the details. Most of the instruments that I've seen anticipate the possibility of a price round later and say either they can pay off the debt all at once, the 3x, just take it out of the investment, or they can run in parallel. That's also fine. I think that one of the companies that I've been working with in this area, one of the entrepreneurs actually took on this kind of revenue-based financing and is still paying it off, and that's fine. And they're trying to raise an equity round. So all of that is fine. What I'm more concerned with is a VC is going to say, I've got 2 deals. One has this weird revenue-based financing, and the other has a convertible note for regular equity. This one's too complicated. I'm going to throw it out. I don't have time. And so I'm more concerned with the perception than with the reality.
Okay. The next question. Since there is no collateral, in the event that the company does not pay the revenue-based financing investor, what actions would you take?
Well, it depends on the model. If it's a debt model, and if it's you can say we need to be paid off, and if you're not servicing your debt, there are legal consequences to that. In the case of the NDVC model, it's a contractual obligation. So again, there are civil penalties, civil remedies that can be taken. You can sue the company and say, hey, we're going to take it, and the court will support you. Now, if there's no money, there's no money, so that's a problem. But usually there's some money, and if you are a debt holder, you have a right to it. And if you have a contract, you have a right to it. If it's an equity basis, there's not much you can do, I suspect. You can fire the CEO if you have enough equity. But those are tough questions, and that's one of the downsides that I did list, is that we don't know what happens if you stop paying, and we don't have enough experience. And it may be that one of the various models or a new model of investment for RBF will solve these problems once and for all. I'm not super optimistic about that, but because we're at the beginning of this journey, it's going to take a while to figure out what the right models are, what the right clauses to add into our contracts, debt or equity arrangements are to prevent blow-ups like this.
Okay. Next question. How do the company and the investor decide what multiple gets repaid to the investor?
And I think the answer to that is how quickly it's going to get paid back. So if it looks like the growth curve or the linear growth is steeper, then we can take a smaller multiple because we expect it to be paid back more quickly. Companies that are bigger already at the outset will pay us more, so we can get paid back more quickly. If we have to wait longer, we want to get more. That's just figuring out the internal rate of return. And we're all going to negotiate around the projections to say, here's what we think is going to happen. The investors are going to say, no, it's going to be a little less than that. The entrepreneurs are going to say it's going to be a little more than that. These were very conservative numbers. I can't tell you the number of times I hear that. And so there's a negotiation process, both around the percentage we're going to take, because that depends on their margins. If the margins are bigger, then we can take a bigger percentage and get paid off sooner and maybe take a 2x or a 2.5x rather than a 3x. it's a negotiation process. And again, since we're at the beginning, we're going to be groping around a little to find the right answers. When I spoke to Looney last year, he said, you know, we took on companies way too early in the first cohort from Fledge, so we had a much higher failure rate than we expected. And you know, all of these variables about when you invest, how much they need to be making every month in recurring revenues or in annual revenues, all of these things are input into a negotiation. And as I said, we're at the beginning, we're going to have to learn a lot. But angels and VCs had to learn a lot too. But it's been so long that we've all think it's gospel.
Okay. Next question. How do you strike the balance between the size of the periodic repayments to the investor versus the company's need to reinvest revenue into the business to maintain future growth?
That again is a pre-investment discussion. We know that companies need to reinvest some of the capital. That's partly the grace period that we give them. How long is it going to take you to build the thing that you need? And so we need to know that or discuss that up front, because that's a reinvestment period. That's an investment period on our dollars. But all of those things will come out in the discussion and in the instrument to say, is this the right set of numbers to work with? And if you need to reinvest to become a unicorn, we're going to say, you're not for us. You know, reinvestment just for growth is not the sort of thing we're expecting to support. And so that's an education problem for the entrepreneur.
All right, next question. Can doing more revenue-based financing deals reduce the overall risk of the portfolio for an investor?
If it doesn't, we have failed. Okay, in order for the revenue-based financing model, where we're only taking 3x out at the max, in order for that to work, we need to flip the numbers so that only 30% of our companies fail rather than 70% fail to provide return. If we continue to fund companies on this basis and only get 3x out of the successful ones, we're going to lose. There's no way to make money at that point. So we have to be far more selective up front, those companies that have a good chance of succeeding and paying us back. Otherwise, it's just a losing proposition. And that's the piece that most investors have trouble getting their head around, especially my colleagues who are seed stage investors, is, you know, those companies fail for many more reasons. And so, you know, how do we reduce their rate? And my answer to that is, initially, at least, we're not going to be doing revenue-based instruments for those seed stages. It just doesn't work. That's what Looney learned in his first cohort. So we don't want to make that mistake initially. Over time, we need to figure out how to get them from seed to revenue-based instrument. That's a later problem, in my opinion.
Okay. And why do you believe that the revenue-based financing model is a more humane model?
Well, if we're right and we lose only 30% of our companies, that's already a huge increase in the number of companies that keep going, keep hiring people, keep paying taxes into their communities, and keep doing what we hope are good things that people are willing to pay for. That's already wonderful. As far as the people involved, the CEOs who get axed by their investors, they're not happy people. They're usually very committed. They're passionate about their companies. These are things that they've invested a lot of sweat equity in. And then to be told, you're not the right person, is very, very difficult for them. And so that's a problem. And then there are all these companies that provide value and can't really get going because they don't have any funding. And revenue-based funding has the potential for helping them. You know, I see a niche product, they're making money, I can't look at them because it's a niche product. And those companies could actually be good investments, but they have no avenue for money right now.
Okay. how has pitching by video impacted the investors getting comfortable with a startup management team?
I'm sure it has. Many times, though, the companies that pitch, we've had extended discussions with over time. Companies don't come over our transom and succeed. You know, someone doesn't just say, "Here's a pitch deck, let's go." What typically happens in the angel group environment is you identify a couple of angels who become your champion in the group environment, and then the pitch is to rope in a lot more investors. What we're also seeing and actually considering doing at Walnut is sort of a flipped model where we already have a couple of members who chair the meeting each month do a lot of screening of companies, and we do that all now via Zoom. And we could record those sessions and maybe do 2 sessions for the companies we select. And then the meeting becomes less of an introduction because we have these recorded things and the members can just watch them. And then we can spend our meetings far more productively asking more in-depth questions of the entrepreneur where the group mind really shines. And I think that model, we're talking about trying that for a couple of meetings at Walnut. I think it's an excellent model and will change the way that deal screening and deal and diligence is done.
Okay, that sounds like an interesting way to change the process. Are there any other questions from the audience? Okay, I don't see any other questions. So thank you very much, Ben, for this informative presentation.
Thank you for the opportunity.
Sure, we appreciate you sharing your time and expertise. Please watch our website for future upcoming webinars at actionnewengland.org. And thank you for joining us today. We hope you found this informative. Thank you and have a great day.
Thank you, everybody.